Hello and welcome to the Fundamental Value podcast, hosted by Joshua Frank, co-founder and CEO of The Tie. On Fundamental Value, we speak with leading analysts, traditional finance and digital asset firms, and investigate how leading minds in the cryptocurrency space research, analyze, and quantify the value of digital assets. Quick disclaimer, this podcast was recorded and is being made available solely for informational purposes.
Hello and welcome to Fundamental Value, a journey to quantify crypto. I'm your host, Joshua Frank, co-founder and CEO of The Tie. So I'm very excited to be joined in person with lots of technical difficulties, which we'll get into in a second, by Rabia Iqbal, who's managing partner at Nural Capital. This is a very special episode for us because we are recording in person on a MacBook with no technology, which is kind of an accident. Rabia is a fantastic guest who's got so much intel and insight on the market, and I promise it's worth the less high-tech and more bear market-ish experience of today. So Rabia, it's great to have you on.
Well, thank you so much, Josh, and so good to see you in person. Thanks for inviting me to your offices. It's definitely that kind of time. It's a dark time in crypto, and we're adapting to the ever changing.
Yeah, we had to return the equipment. The Black Friday deals weren't good enough here. We're down 80%, and the 60% off didn't.
Well, the best thing I saw on Twitter for Black Friday was actually, what are the good deals right now? And somebody posted tech stocks and crypto.
Yeah.
It's that kind of time.
So why don't we get right into it? So can you walk us through your background pre-crypto?
Yeah, totally. So, before starting Nural and before getting into crypto, I actually started my career at Morgan Stanley. I was on the equity derivatives desk there and did a little time in the wealth management division at Morgan Stanley as well. Then moved to the buy side, was at Co2, and worked at Nural Capital, which is the Abu Dhabi Sovereign Wealth Fund. Kind of during that time, 2017, I personally got involved into crypto, started investing personal capital. And then around the time I was at Mubadala, I just got, into it a lot more, personally spending just all my free time, meeting people in the space, diligencing funds, meeting managers in the space. And I got to thinking, this is something that I need to do full time because it's just taking a lot of my time and energy. And it's just so interesting. Everything else seems uninteresting. And so ended up launching Nural actually about a year ago, a little over a year ago. And it was great because we had the backing of Kinetic Capital, which is one of the earliest blockchain venture funds in Asia, and they were very supportive of what Nural wanted to do. And yeah, I mean it's been a great experience. It's been a long year, but yeah, that's kind of how we got started.
Yeah. So why don't we talk about so why start Nural Capital? Why does crypto need another fund? Nural's a little bit different because, and I think you'll get into this, so I won't lead the question. But yeah. What does Nural actually do in the space? What type of fund is it? What do you invest in?
So Nural is a diversified access point into investing into the blockchain space. And I mean, let's unpack that a little bit. So we are a hybrid fund where part of our investing is done through a fund of funds and part of it is in direct investments, and that's all packaged in one vehicle. Personally, when I was investing in crypto, I thought the best way to get exposure was doing a couple direct deals myself and then aligning myself with really skilled managers who had subsector specialties within the space, because the technology is moving way too fast. You just can't, as a single person, understand everything that's happening, especially if you have a day job. You have to align yourself with with people who know what they're doing, people who are living and breathing this. And especially when the markets are so volatile, you need that extra special expertise and that connectivity. And so Nural combines the fund-to-fund investing with the direct investing, and that creates a very diversified product. So when we think about our portfolio construction and what we want to deliver to our LPs, number one is diversification. Because when you're in an asset class that's so nascent, you want to take advantage of the power law. And you want to be as diversified as possible, touch as many portfolio companies as possible. And one fund manager, can deliver that for you, but our portfolio has 10 fund managers. And you multiply that 10 fund managers by those amount of portfolio companies that you have, and you really are touching the entire space. The second thing that Nural likes to do is we like to be an access vehicle. So for a lot of my non-crypto friends and former colleagues used to say, Rabia, how do you access the space? How do you know who to put money with, or how do you even get access to these opportunities? I read about this stuff online, or I hear about it, but I don't know how to do it. And Nural is really supposed to be one of those vehicles that people can come into and access the space, right? It's really hard to get access as a accredited investor to private opportunities, but Nural kind of solves that. And then our third value proposition is education. We are very committed to educating our LPs. We're very committed to educating the community on investing in private markets, investing in funds, and investing in blockchain and crypto in a risk-managed, diversified way. And so that's why Nural was formed. We wanted to deliver those three core concepts: diversification, access, and education to LPs. And we wanted to kind of take the stigma away from investing in crypto, investing in something you don't understand.
So you mentioned risk management a bunch of times. So as you look and you diligence funds, obviously this is a point that's becoming even more relevant these days with everything that happened with FTX and with Genesis and with a bunch of different counterparties within the crypto space. How do you go and assess a fund manager's risk management?
So we apply a rigorous investment due diligence process as well as an operational due diligence process. And this is very key when you're investing into a fund. And I think sometimes this is lost on people, and especially, over the last couple of years when there was such a hype to get into funds, people didn't really think about the ODD. We go in and we ask questions about compliance. We ask questions about custody. We ask questions about service providers. One of the things that there's so many things that have come up during this process that you just wouldn't even expect.
Yeah, can you talk about some of those?
Yeah. So we had one fund that we loved their thesis. We loved their investment process, how they thought. Their track record was fantastic. But on the operational due diligence side, we go through and we talk to service providers. It takes a long time for a fund to get through our diligence process. So we asked them for their service provider list. We asked them if we could, speak to some of their service providers, and they refused to introduce us to one of their service providers. And that was an automatic red flag. If we can't talk to the counterparties that you're doing business with.
And service provider, you mean primarily their custodians and their
exchanges. In this case, it was the exchange that they wouldn't introduce us to. And it was just a non-starter for us. If we can't get to know who you're doing business with, we can't get into business with you. If you take a step back, right, the LP-GP relationship on a venture fund, and we primarily at Nural invest in venture funds, those are typically 10-year relationships. 10 years is a long time to be in a relationship with someone, right? And you think about how many people in your life you're in a 10-year relationship with, and you have quarterly communication with. That's probably not that many people. And this is what you sign up for when you sign up for a fund. So you want to be able to, properly go through the dating process as well with those fund managers. And you want to be able to ask questions and understand who they're friends with or who their counterparties are and everything. That's kind of lost on people sometimes, or it's not their core competency. And so sometimes people just rush through it. That's what we at Nural, strive to solve for, making sure that those 10-year plus relationships are actually sound.
And so fund of funds have generally, become less prevalent in more traditional markets. Why do you think that is? And why do you think there's such a big opportunity within crypto?
Yeah. So, this is one point we've talked about before with the access, right? So, typically now to access a hedge fund or a venture fund, you can do that through some IRA platforms, some newer LPGP platforms that are popping up. Some private banks actually offer access to venture funds and hedge funds, and some of them are top tier products as well. But in the crypto space, it's still really hard to access top tier funds. And to define top tier funds is hard as well because the asset class is so new. And so while hedge funds were a really big thing, or fund of funds were really big in the 90s because that was a nascent industry then, it's almost the same now where crypto funds are a nascent industry, and the fund of funds products exist to deliver the access to the LPs who want to invest. And it is a lot of people like the fund of fund product because they can get diversification, because there is more transparency. If you go through a fund of funds, and intuitively you think, oh, there's less transparency, there's less direct contact with the manager. We get that feedback a lot where, I'd rather go direct because I want to be able to talk to the manager direct. Well, you have less leverage if you're just one LP talking to that manager versus if you come through a fund of funds whose day in, day out job is to talk to that manager and ask questions and evaluate that manager against other managers. And so, people who opt in for the fund of funds realize that they get better service if they go through that model as well.
So, we mentioned earlier, or you mentioned earlier rather, that you're primarily investing in venture funds. Why is that? Why specifically venture funds? Have you invested in hedge funds, more quantitative strategies? And has that shifted at all, kind of over the last year for you?
Yeah, so we have a broad mandate which allows us to invest in hedge funds and liquid funds. And we've looked at a number of them. We have taken the view here at Nural that we are investing in this space for the long term. And while there are opportunities to make money and to find value in liquid markets, it's just a little hard with all the volatility and all the noise to be able to evaluate those managers correctly. And then there's also a little bit of track record replication. And so, you'll hear about some fund managers having monster years one year and then, huge drawdowns the next year. And this becomes very, very difficult when you're trying to manage a whole portfolio as a fund of funds. And so we've taken the view that we are going to we are long-term investors in this asset class. And the best way to get exposure to that and to manage the volatility is to invest in venture funds. That doesn't mean that we might not find a hedge fund or liquid fund that is kind of an all-star, that we really believe in their thesis and how it fits with our entire portfolio. That could still be the case. But for now, we've just found that the volatility is way too high. And managing that for the long term is a little difficult.
So from a venture perspective, and from evaluating a venture fund manager, right? I mean, most of these folks don't have a track record in crypto. I mean, crypto venture investing is, obviously there were some deals that happened in 2013, 14, 15, but for the most part, unless you got into Coinbase or Kraken or a few of these exchanges early, there really isn't much that has kind of transpired. And, I think even 12 months ago, you would have looked at somebody who invested in, BlockFi and said they had a great track record, or somebody who invested early in FTX and said they had a great track record. And so how do you evaluate track records? And do you have a predisposition towards investing in like traditional venture funds that are now rolling out a crypto investment vehicle, or a traditional venture fund manager who you can be like, hey, look, this person was at Union Square Ventures or X or Y or Z place for 20 years and has an incredible track record, so we think they can evaluate crypto. So I know there's a lot to unpack there, but
yeah. So when we're looking at managers, in our deck we have that classic funnel slide, right? I mean, we look at the universe of managers, and then we look at their process, their investment process. We look at their track record, and you're right, track record has many different definitions in crypto. But we have this other screen, which is called our crypto native screen in that funnel process. And basically what that does is that's where we do a lot of reference checks, and we do founder calls as well. And so on the crypto natives check, you're right. Like it's still such a nascent asset class, but we're backed by Kinetic Capital. They've been investing in the space since 2013. They've done over 250 portfolio company investments. Chances are, if there's a manager out there who's claiming that they have, a 5+ year track record in crypto, they've invested alongside that manager. And so we rely heavily on them to tell us how the experience was investing alongside that manager, whether they've done deals with that manager, how that went. And then we take it a step further. We'll ask founders for feedback on fund managers. So let's say, maybe 6 months after a round closes, we'll go to some founders and we'll say, on your cap table, we see these, 10 funds. Who do you still talk to? And, chances are they'll be like, oh, well, we only really talk to 3 of these funds. And we'll say, okay, who's most useful to you? Who's been, who's kind of disappointed you in that way. And so we actually have this proprietary tracking system from the founder perspective. And we'll go and we'll say, we'll rank the venture funds based on the founder's perspective. And what we say at Nural is, yes, like backward looking track records are important, but you're only as good as your next best deal in crypto, and getting in early is hugely important. And so if you're ranked well by founders, that is an indication that your next deal, that you have a good chance of getting into the next best deal. And that's why we keep that ranking system. And that's how we look at track records as well. We look at forward-looking track records as well as backward-looking track records.
And so one of the things you mentioned earlier was getting allocation to fund managers operating in different sectors. And so how do you think about that within the investor landscape? So obviously, as I think about tokens, I think about DeFi and privacy coins and metaverse and things like that. Do you think of that in terms of investing in like token venture funds that hit on those different sectors? Are you looking at investing in different stages of equity venture funds? Like, how do you actually think about building a diversified set of fund managers?
Yeah, so it's both. On the subsector side, we do look for managers who have exposure to NFT gaming, metaverse. That's kind of like one category. DeFi is another category, and then Web3 and infrastructure is kind of the third category. We broadly try to bucket some of the managers, and then we have some generalist categories as well, because this space is ever evolving, and we need to be able to just adapt to anything new that pops up as well. And so broadly, like to bucket people in that way, but then also across stages, it's really important when we're building our portfolio to have mostly early stage, then some mid stage, and then some growth stage. This is kind of one of the things that we've done differently than a few other fund of funds. We think growth is important as well, and so we have one growth fund in our portfolio. It's important to have companies with revenue show up in our portfolio, companies that people can actually recognize, that could have an exit sooner, that we could recycle capital or return capital to investors. And that's kind of our rationale behind the growth side of the portfolio. And then early stage exposure is important too, because that's where we're going to drive a lot of the alpha for the portfolio. And then these are like the newer, interesting technologies that we can really watch transform all the way through the life cycle of the fund. So yeah, I mean, we structure things a little differently on the growth side, and then also on the sector specialty.
And what about on the token versus equity investment side? How do you think about that?
Yeah, so we at Nural are not token experts by any mean. So we rely heavily on our fund managers to do the token investments. It's just, it's not our core competency to underwrite.
Do you invest in any fund managers that only do token deals, or would you evaluate them the same way that you evaluate any other fund manager?
So we don't invest in only token managers. We have a skew towards equity. Our understanding of tokens is they have value, but sometimes there are tokens just exist to exist, and they don't always solve a problem. And so, or they don't, there's not always a purpose. And so we have historically.
I think you're putting that lightly.
Yes. Yeah. I mean, I'm not going to call out any specific projects or anything, but there's a lot of noise out there. And because we can't underwrite it, we don't feel comfortable with it. I'm not going to say that we're a no token fund. We obviously have token exposure. I think that's really important if you are trying to get blockchain exposure to have that. But that's not going to be an emphasis of our portfolio at Nural, because we're a 10-year fund. We need to make sure that token is going to provide value over the next 10 years. Or be able to provide value to our LPs in the short term and deliver and provide distributions to our LPs. So yeah, I mean, it's not always the most favorable thing when you don't want as much token exposure, but we try to stay away from it.
So obviously the market has changed quite a bit in the last few weeks or month, with the FTX collapse and the ensuing chaos that is. Yeah. Kind of, made its way throughout the entire industry. And so, with that, how difficult is it for fund managers to actually raise capital right now? Where are you seeing the most interest among, your peers? I'm going to define broadly as any LP in a fund, right? So we'll go broader. It could be an allocator. It could be a high net worth. It could be a family office. Where do you see the interest among kind of allocators broadly in putting capital? Is it on the venture side right now? Is it on the market neutral quantitative side? Because what I was seeing kind of leading up to this collapse after Three Arrows was this push towards these market neutral quantitative funds, mm-hmm. but a huge number of them had 50% of their capital on FTX, right? And so I'm curious as to if you're seeing any demand among investors, how the macro picture has affected it, how the more recent collapse of FTX has affected it, and where specifically that interest lies.
Yeah, so that it's been an interesting change, right? What we're seeing now is, and I do remember that many people were asking for market neutral strategies. People wanted exposure and they wanted it packaged like that. What people are asking for now are just deals. Like everyone who is sitting on the sideline and has capital and wants to deploy it to the space. So that's
by deals, you mean like a good deal? I
mean like secondaries.
Yeah, yes.
So that is the number one question that we
and can you guys deploy to secondaries?
We can, and we actually are in the process of putting together a secondaries fund. And so is
it specifically focused on distressed, or is it just any you think relatively undervalued secondary?
So we are starting with a secondary LP positions. LP positions into blue chip funds, and just secondaries around that. And then we have been seeing people asking for, specific distressed assets as well, but that's a little. What we haven't seen as many transactions happening there. So like people still aren't sure where to pull the trigger, whereas they're a little bit more comfortable with buying an LP position. Because
so how do you evaluate a secondary LP position, right? Like let's say I'm an LP in X fund and I want to sell, my entire stake. How do you actually value that? Like how do you mark to market a book? Do you have insight into what's actually the holdings and positions within that? How do you actually go about that? Because when you're investing in an earlier stage VC and you're giving a capital at the earliest stage with like a 220 model, like the fund was just set up, right? You don't really have a book to value. But how do you actually go? And I'm like, all right, this venture fund is 4 years old. It's a 10-year fund. It's fully deployed, right? How do you actually think about valuing the assets in that book?
It's really very difficult for people who don't do this every day. So we spend a lot of time doing that. So
and I presume you're seeing the same deals in a number of different books anyways.
Yeah. There's definitely overlap. So and what we have is we get NAVs from our fund managers, and every manager is supposed to report on a quarterly basis. And most of their investments are on there. Some are in stealth, so you don't get to see everything. We've heard kind of from other peers of ours that you just take a 30% in this market. You just take a 30% haircut off the top of that NAV, because managers aren't necessarily baking in what the prices are. They haven't devalued their investments yet. I mean, I think it will be very interesting.
And so then you want to get a discount to that 30% discount.
Exactly. Yeah. And so that's where the negotiating starts.
So if you're investing in, let's say, a 10-year fund and it's 8 years in, right? You guys as Nural, are you a closed-ended fund yourself?
Yeah.
And so are you able to redeploy that capital? So let's say you invest you invest in secondary LP positions in a venture fund where there's a year or 2 years left on that, so you're going to get liquidity much sooner. Right. Can you reinvest that capital?
We can, because we have a recycling provision in our fund. But we can also distribute it to investors, right? So there's that kind of comes back to your point about evaluating managers and track record, right? And one of the things that we do a lot is, we look at fund managers, we look at their track records, but what's most important to us is DPI. And the value that they've brought to their investors. There's plenty of funds that in 2021, when they were raising, they showed MOIC of like 10x, right? And, they raised large sums of money off of that, and then now that 10x is now sitting
2x.
at like a 2x or whatever, right? And that's not value to investors.
Right.
So I take your question about recycling one level further, because I want to kind of just stress the point of, it's not always about reinvesting capital. Sometimes the prudent thing is to like find a great deal and then deliver value to investors as fast as possible. And that's also kind of going to be key to the space and how people reinvest capital into the space, right? I mean, if you're a family office and you are, you got yourself access to a fund, and you just keep seeing the number go up on your quarterly statement, that's all great. But when are you going to redeploy capital into the space? You're going to redeploy capital back into the space when you get returns. So that's only going to help people kind of continue to invest in the space, I think. So that's like a pretty important part of what we do too, looking at the DPI of how funds return and thinking about that in our portfolio as well.
So you mentioned earlier, you don't really do hedge fund investments, so you have the ability to, you haven't really. I'm curious, how many venture funds do you think had exposure to FTX? Because I think it's probably more indirect than hedge funds, because hedge funds probably had capital deployed onto the exchange. Obviously, a venture fund could have a position in FTX stock, or any of those other entities that were kind of impacted. But I'm curious as to what percentage of venture funds you think had like some significant exposure, which maybe we define as more than 5 or 10% of their book had some exposure to FTX.
Yeah. And from what we've been seeing, exactly what you said, it's been minimal.
Right.
And that first...
But I presume on the hedge fund side, it's a lot more aggressive.
On the hedge fund side, you're seeing it a lot more. And you're seeing people who... You're seeing the concentration to be a lot more too. Like there were some people who had highly concentrated positions in FTT or highly concentrated number of assets on the exchange. And so you're just hearing that.
Or heavy investment in Solana, which
is
so for perspective on this, by the way, so this is a number from one of the largest custodians in the space that has about 1,500 clients. I won't disclose who it is. Because they can see the assets, they think 50 to 60 funds are 100% need to go out of business because of it.
On the hedge fund side.
On the hedge fund side. So that's about 3 or 4%. Is what which 100%, like they're so far below their high watermark, there's just no chance. But it was a surprisingly low number to me, but I think they believe there's more, and that's kind of in line with what we're seeing talking directly to funds, where we think there's 3 or 4% of funds were like really hit. And then there are other funds that were hit significantly, but I'm not really hit, I'm defining as like 50% or more hit.
Yeah. So that's interesting, right? Because during this whole, during the whole FTX fallout, we've been trying to quantify contagion and impact. And it's been, it's been a road to do that. It's been a lot of, it's just been a lot of work, because the first layer impact is, it's very easy to see, right? It's defined by people who have FTX equity exposure, FTT token exposure, and then assets on FTX.
Or Alameda.
Yes, exactly. And so that's how we define the first layer of impact. But what's the second layer of impact for venture funds? It could be, it could be their portfolio companies having raised money from FTX and having gotten a portion of the capital in cash, but then a portion in FTT tokens.
Or their treasury on FTT, on FTX rather.
Or their treasury there. And to do that analysis, you have to dig really deep.
Well, I think it goes even further than that. I mean, you could start to talk about mining.
Exactly.
which is a massive issue, right? And I'm sure you have some portfolio, some venture funds, I'm sure had some exposure to mining. Basically every mining company's out of business, right? I mean, mining firms, miners weren't making money at 25 grand Bitcoin. They're certainly not making money at 17K Bitcoin. And they were, borrowing a tremendous amount of money, which has impact back on lenders, right? And you could have some of your portfolio companies lending to those lenders, right? I mean, I think it's impossible to quantify the impact because we still haven't even seen it. Like we just saw with Maple yesterday, with orthogonal being 80% of the Maven 11 pool and defaulting on that loan. Who was lending to that Maven 11 pool? Well, it turns out Nexus Mutual had a ton of loans, and I'm sure there were a lot of early stage venture investors in Nexus Mutual who had a big markup on that position. Right?
I mean, it'll take months to figure out what the contagion is, if not years.
Yeah.
And you bring up a good point on the mining. It's like it's not even directly related to FTX, but that's like a huge impact that we're seeing. And that's actually an area where we're seeing managers hunting for distressed opportunities as well.
You got to be really careful on the mining side. I mean, the biggest problem, mining equipment is now trading about a 90% discount from the top. And I think it's going to be even larger once all the Celsius assets as part of the bankruptcy hit the market. So they have 200,000 pieces of mining equipment hitting the market.
Yeah.
And the question is who's making money, right? Yeah. Who's making money? I think it's very difficult. And, there's, the contagion then goes out to all the other lenders, right? That were lending to miners. There's a number of them. Not going to call them out, but, for anyone listening that wants to look, just go type in SEC filings for miners. You can look at the 8Ks and 10Qs and you can see who's lending to these miners. Yeah. And you'll start to see like insurance companies lending to miners, like not even crypto natives, like there were insurance companies lending to miners.
Yeah.
So there's going to be a lot of kind of net impact. I think we got a little distracted from the main point though, which was really kind of finding opportunity and I guess understanding the impact on venture investors. So one of the things that you mentioned though earlier is the fact that you're looking at secondary LP positions right now. But I wonder, given the blow up of FTX, you guys also do direct investing. We haven't really talked about this on the podcast so far. But how do you think about opportunities for direct investments versus secondary investments in funds or direct investments in fund at this point?
Yeah, so the direct part of our portfolio is a smaller part of our portfolio. Our core competency is diligencing funds, understanding how managers compare against each other and what their edge is, and kind of building a portfolio around that. The direct part of our portfolio has always been doubling down on companies that we think are strong from our managers' portfolios or that we found that kind of solve for something else. And it hasn't been a core focus. And going forward, our thesis has only strengthened on investing in managers and kind of grabbing that diversification and that manager expertise. Again, like you said, you've got to be really careful right now on distressed opportunities. There was a time where, like you said, BlockFi was a great company. And today we're seeing that it
always lost money. I think the perspective of people in venture investing on what is a great company sometimes is a discussion to be had.
Yeah.
But certainly it was a very fast growing business.
Yes. It was, but at the time, it was one of those things that, to your point, like it was like on people's track records, and it was like, oh wow, you got into that, like that's fantastic. And now it's sitting, it's bankrupt, and you really do have to be careful because the space is moving so fast, and the fallout, like, it's still yet to be determined. So if you are going in there and picking up distressed assets, single assets, you have to really do your work on those assets. And it is not easy to do that work, right? If you're
well, especially when, you have investing in distressed, you might have limited information as well.
Limited information. You have to move quickly. people who are doing this or have been looking at that company for a while might have more information than you. Like you might not be operating from a position of strength. And so, from our perspective, we're doubling down on what we do really well, which is find fund managers who kind of produce outsized returns compared to their peers. We create great relationships with them. And if we see opportunities kind of come through them that we feel really good about, that we can ask really thorough questions on, we would do like a direct investment. But at this time, we're really focused on fund managers and not just direct opportunities.
And so obviously on the venture fund side, you can't really have net withdrawals because these are closed-ended funds. I'm curious what you're seeing on the more hedge fund side, the open-ended side. Do you think there is a massive push to withdraw funds from these exchanges? I guess as a proxy, you would probably be able to see who's actually selling their LP positions in venture funds is probably a somewhat decent proxy. But I would assume that the hedge fund side is even larger just because it's very easy to withdraw from a hedge fund. It's less easy to sell secondary, LP positions in a venture fund.
Yeah. So on the hedge fund side, it's a little tricky though, because some of these funds have, massive drawdowns, right? And if you've lost 80 to 90% on a fund, you might not want to take the money out. You kind of want to just see it go back to something. It's
actually really funny. It's this human psychology thing. It's right. Like if I was would you rather have $100? Imagine you bought an asset at $1,000. It's now sitting at $100, or would you rather have $100? Right. If you thought about the position on its own, you might be like, I'm just going to ride this out.
Yeah.
But if I was like, hey, if you had $100 and you put in anything, would you put it in that thing? The answer is probably no.
Right.
Which is kind of this interesting. And look, I suffer from it. And I think a lot of others do. Right. Which is just naturally you're down so much on a single position. You're like, fuck it. I'm just going to wait. I'm just going to ride this thing out. When in reality, if you were given that same amount of capital, you'd probably deploy it elsewhere.
Right. And that's why, selling is so hard, right? And it's really hard to time things. And we don't on the hedge fund side, naturally you'd think a lot of people would be redeeming, but I'm not seeing that as much. Human psychology, people want to see if they can, wait it out, they've already lost all this money.
And you might be seeing it more in the not deploying than on the redeeming side as well.
Yeah. Yeah.
But were funds or were allocators already not deploying very much post-April of this year and it slowed down even further, or was there still some active allocation going on?
So post-April, there was a crypto curiosity. So I wouldn't say that people were, jumping up and down to allocate, but they were still crypto curious. They were hunting around for deals. They were looking, they were, trying to understand where they could get opportunity. But now it feels like there's pure exhaustion, and people don't know who to trust, and that's a different situation, and that's because of the fraud from FTX. And so there's going to have to be a little bit of a rebuilding period with allocators, especially institutional allocators, to get them comfortable around risk metrics and just financials, and a lot of people are just waiting to see what happens, the fallout from Genesis and like how that all goes down. And so people are okay waiting. I wouldn't say that there was that many dollars going into the space after April, but there was capital. But that being said, there are people who are this is the one trend that I've heard a lot from managers I've spoken to. People are deploying this month. A lot of people who haven't been deploying are deploying.
So how much from the fund managers you've spoken to, how much dry powder do you think they have as a percentage of their most recent funds left on average? Obviously, it differs
Yeah.
significantly.
Yeah. I mean, it is case by case, right?
But do you think there are funds with 70, 80% dry powder?
There are a handful.
Okay.
Yeah, a handful.
Right.
But there are also funds that are close to tapped out, right? People are getting ready to go back to market in 2023. I'm hearing that a lot. And I'm hearing like maybe Q1, maybe Q2. I think LP sentiment, allocator sentiment will drive a lot of when people go back out. But you're hearing rumblings of it for sure. There are a few people who do have dry powder. So deals are still happening. Deals are still getting done, but not to the pace.
Well, it got egregious.
Yeah, it was crazy.
And so, you previously worked at Mubadala, which for anyone who doesn't know is, one of the sovereign wealth funds of Abu Dhabi. What I'm hearing a lot from a fund manager perspective is this really big push to actually go try to raise capital in the Middle East. I'm curious as to, I think you know that market better than almost all. Do you think that there is an appetite among Middle Eastern investors that tends to be stronger than other geographic regions at this point to get exposure to crypto? Because obviously, most of the world's economy has gotten very impacted by raising interest rates and more of a macro picture. And I think there's a tightening broadly in allocators across the globe, across asset classes' ability to allocate. I was just in California last week and paid $6 to refill my tank. So, oil producing countries are still very well capitalized and still underdeployed. So I'm curious if you think that's an interesting opportunity for crypto and for fund managers specifically.
Yeah. One thing I think is really important to note is that Middle Eastern investors are very, very sophisticated. And, I worked in the New York office for Mubadala, and that's one of many international offices. So, just to put that in perspective, these allocators have now had offices in other places. They've been, they've been in the deal flow. They've literally been building companies and investing in companies for many, many years now abroad. And crypto is no different, right? They've been getting access to crypto investments for a very long time. They've been doing their
through fund investments primarily, right?
Through fund investments, but also some directs.
Right.
In
tokens as well, or mostly equity deals?
There's been some tokens, but mostly equity deals. But they have access, and I would say the most important thing if you're a fund manager is to understand that you're dealing with a sophisticated investor at the other side of the table, right? And so you want to make sure that the deals that you are bringing them or showing them are the best deals that you have, because they're getting access to a lot right now. I'd also say that there is a lot of trust that needs to be built too. So a lot of people will reach out to me and say, like, I'm going, I'm headed to the Middle East, and I'm talking to XYZ people there, and I'm hoping to come back and have raised my fund, or like be on the way to raise my fund. And I always say, like, it takes a lot of time and trust to build those relationships. Again, like an LP-GP relationship is mostly it's a 10-year relationship, and people don't take that lightly, especially if they don't see you every day, or if they like physically aren't around you or in the same country as you. And so spend the time to get to know people and get to know their portfolio and their needs too, and then you'll have a better chance of being successful.
And so you're on the Fundamental Value podcast, so naturally we have to talk about fundamentals. And so, one question that we ask all of our guests is about fundamentals, and this is more on a token basis. So how do you actually think about fundamentals for digital assets, especially its tokens? And I think your perspective is appreciated here, given that you're mostly doing equity investing in the space or focused on venture funds that participate in equity deals. How do you think about the actual, you mentioned earlier that a lot of these tokens don't accrue value or don't make sense. They don't need to have a token. And so when does a token need to have a token? How does it accrue value? Are there any fundamentals, or is it mostly just nonsense?
No, I mean, there are obvious examples of when tokens are important. And one of the things that, we believe that fundamental analysis and price are important. Like those things matter. We just happen to be in a very nascent asset class, right? And no one can predict exactly. And if people tell you they can predict, or, like last year we had a bunch of people kind of saying, oh, Bitcoin to 100K or whatever, like no one can predict what's going to happen. But your analysis can drive price ranges and can kind of create kind of a range for you to base your investments off of. But what's important is that you, instead of being like, okay, this is definitely going, or like these investments are definitely going to go to this price or this price, we know what to invest in, because this asset class is so new. There's a lot of emphasis on what not to do, and a lot of learnings on what you should avoid. And so, clearly you should avoid concentrated positions like what we saw with FTT tokens. I mean, you should, that should never have happened. FTX should not have held that many FTT tokens as collateral on their balance sheet. Other things that we should see, other things that we should avoid stable coins like Terra and Luna that aren't structured properly. Like those are things that we should stay away from. We should avoid poor risk management. So like now we know things that we should avoid, but there's no, because this is such a new space. There's no kind of one way fundamental research that can tell us like, where the secret door is, like to value. We're still all figuring that out, and we're still all trying to find value in that way. We invested in a company called Snickerdoodle, and basically what Snickerdoodle does is it encapsulates your web browser cookies into an NFT, and as you're browsing the web, you get access to, or you get dropped Doodle tokens. And so you, the user, are accruing value for what you are doing kind of in a Web3 world. You're the content creator and you're getting, compensated for that. We find something like a Doodle token to have value because you can eventually kind of, everyone who's in that system is accruing those tokens and can transact in that way with other people who have Doodle tokens. For other tokens like governance tokens, they don't have as much inherent value other than like maybe being a governance token, but the value accrues to like equity holders of those companies. And so it's kind of harder for us to diligence that and kind of apply actual value to those tokens. So that's kind of how we think about it. But again, I mean, Josh, it's hard on tokens. It is just, we know to avoid things like Dogecoin that have no inherent value, but like there's like a fine line too.
And so amidst the chaos of digital asset markets, what do you think are the most exciting areas and sectors and opportunities that are going to emerge over the next few years?
So DeFi is something that we hear a lot more from our managers. For a while, especially after Terra Luna, it kind of died down, and now it's picking up again. You saw that after FTX, the volumes on the volumes for Aave and Compound and were increased, and then Uniswap overtook Coinbase for a while after Binance for trading Ethereum, and there is a pure emphasis on people wanting to invest in DeFi, and like the centralized exchange, the concept of a centralized exchange isn't as interesting to people, or there's like inherent, and people are kind of seeing those inherent problems with that. So DeFi will definitely pick up. Self-custody solutions, things like that will be important going forward. But there's huge opportunity there. And we always say it's not going to be just pure DeFi. There's going to be like a regulatory structure around DeFi where DeFi is able to flourish, and it's going to be some sort of hi-fi. So it'll not be traditional finance, and it won't be just pure DeFi. It'll be like hybrid finance. That's interesting.
Too many acronyms.
It's interesting. We're seeing a lot more managers talking about it today. That's the opportunity we see. And then on mining consolidation, I mean, we talked about it earlier. It's like there's going to be some players that survive, and they're going to be really strong. But yeah, that's where we see things going from here. I mean, the recovery is going to be a long road, but we'll see another bull run soon.
Awesome. Well, thank you so much, Rabia. I learned a ton. This was super helpful.
Yeah.
Next time we will have a full setup with we'll be like facing the camera, right? We'll have a nicer camera, microphones. But today that didn't happen. But anyways, this was a great episode. We learned a lot. So where can people find you online? Where can they follow you? Where can they learn more or reach out?
Yeah, so our website is nural.capital. And you can reach out over the website, LinkedIn, and or Twitter. And we are always happy to chat and share our insights on the space and what's to come. So thank you guys so much. Thank you, Josh.
Thank you, Rabias. This was great.